One of the biggest frustrations for traders is watching the market reverse from a level you didn't recognize and wondering, why did price respect that exact candle? Or maybe you've entered too early, only to get stopped out before the move actually begins. Understanding the mitigation block can solve this problem. It helps you identify where institutions revisit price to fill their unmitigated orders, giving you a precise entry level with higher probability and reduced risk. By the end of this video, you'll know exactly what is mitigation block tap entry, the psychology behind it, how to identify a valid mitigation block, and how to build a complete trading plan for mitigation block strategy to manage trades step by step for consistent results. If you are interested in learning advanced trading concepts, strategies, entry techniques, and how to control your trading psychology to stay disciplined in your trading journey, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. When the market is trending upward, it naturally creates a series of swing highs and swing lows. As price pulls back to form a new swing low, the expectation is for it to continue higher. But if price fails to push higher and instead breaks below that swing low, something important happens. The last down close candle of that swing low now becomes the bearish mitigation block. This zone represents the point where institutions and larger players are mitigating, or closing out, their previous buy positions before shifting their focus to selling. On the other hand, in a downtrend, the market moves by creating swing lows followed by swing highs. When price pulls back and forms a swing high, traders expect it to continue dropping lower. But if it fails to break down and instead pushes above that swing high, the last up-close candle of that swing high becomes the bullish mitigation block. In this case, institutions are mitigating their earlier sell positions, rebalancing the market, and preparing to drive price higher. But wait, you might be wondering, isn't this the same as a breaker block? The answer is no, and here's why. A breaker block has a very specific requirement. Before the block is formed, the market must first break a significant swing low or swing high. In doing so, it sweeps liquidity resting around that level, trapping traders who entered in the wrong direction. Only after this liquidity sweep does price reverse and break market structure, confirming the breaker block. In short, a mitigation block is the footprint left behind when the market shows its true direction after faking one side. By recognizing it, you can spot where smart money has adjusted its positions, and use that level to find precise entries. To really understand why mitigation blocks work, you need to think about the psychology of traders and institutions caught on the wrong side of the market. Imagine, price is forming a series of swing highs and swing lows, moving steadily lower. Naturally, everyone expects that the next move will be a break of the most recent swing low, continuing the downtrend. Sellers are confident, and many of them open short positions around the most recent swing high. Instead of breaking the low, the market fails to form a new swing low and instead pushes higher. This sudden shift catches those sellers off guard. The shorts that entered around the recent swing high are now sitting in drawdown, and their positions are no longer safe. So what happens when price returns to that same area? Those trapped sellers look for a chance to close their losing positions. At the same time, new buyers step in, recognizing the failed downtrend as a possible reversal. This combined buying pressure creates momentum and drives the market higher. Now that we've covered the psychology behind the mitigation block, let's talk about the practical side, how you can actually spot a valid one on your charts. This is the part where you move from simply understanding the concept to applying it in real trading. The first step is to start with a key zone. Look for areas where price is likely to react, such as a well-defined support, resistance, supply, or demand zone. These levels are magnets for institutional activity, and where the possibility of a mitigation block forming becomes meaningful. Once you've marked your key level, wait for the retest of that zone. Next step is to zoom into a lower timeframe to get more detail. The heart of the mitigation block lies in the concept of a swing failure. A valid block forms when price attempts to extend the trend, but fails to do so. For example, in a downtrend, instead of breaking below the previous swing low, price reverses and pushes higher, signaling that sellers have lost control. This failure sets the stage for the mitigation block. To further strengthen the setup, look for a market structure shift. This means that the break of a key high or low confirms the failure of the prior trend and validates the creation of the mitigation block. Without this structural shift, the pattern carries much less weight. The last up-close candle of previous high becomes the bullish mitigation block. Now mark the zone from the top of its wick to the bottom of its wick, and then extend it to the left. And here's one rule that cannot be ignored: a mitigation block is a one-time event. Once price returns to the block and fills those unmitigated orders, the opportunity is gone. Institutions don't leave the same footprint twice, so you can't trade the same block again. A valid mitigation block is not just about spotting a candle. When all these elements align, you'll have a setup that carries both logic and probability in your favor. Once you've identified and confirmed a high-probability mitigation block, the next step is execution of your trading plan. Don't rush to hit the buy or sell button the moment you spot it. Instead, wait for the market to return and tap the mitigation block. This retest is the market's way of validating that level, showing you that institutional orders are being respected. When price taps into the block, that becomes your precise entry point. To protect your capital, always place your stop loss just beyond the last swing, giving the trade enough room to breathe while still guarding against deeper reversals. This structured approach ensures you're not only entering with precision but also keeping your risk tightly controlled, which is the key to long-term consistency. For take-profit targets, it's best to think in layers rather than aiming for just one level. Start by securing partial profits at the nearest support or resistance. This locks in gains and reduces risk. Then allow the remainder of your position to run toward a higher timeframe level, where the bigger moves usually unfold. By managing your exits this way, you protect your account while still giving yourself the opportunity to capture those larger, more rewarding trends. Even with a solid plan in place, not every trade will end in profit. A loss doesn't always mean your analysis was incorrect, it's often just the market reminding us of its unpredictability. That's why backtesting your strategy, reviewing results, and sharpening your execution are so important before committing real money. The real edge comes from consistency. By staying disciplined, sticking to your rules, and managing risk with precision, you'll gradually build both confidence and profitability in this setup. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.